Hi there, welcome to Stock Market HQ's market analysis for January 23rd, 2022. So last week we discussed that we were expecting some kind of a big move in the market, possibly in the next 1 to 3 weeks, and that all the market needed was some kind of a catalyst, and we were kind of expecting that catalyst to be the earnings reports of big tech in the last week of January. As it turns out, the big money managers didn't wait around that long, and we had our big move this week. So we want to take, and it's important to understand that there were three drivers or catalysts to that move this week. And those were the first one, Russian invasion of Ukraine headlines, the US Federal Reserve meeting next week, and concerns about them changing interest rates from 3 rate hikes to 4 or even 5 rate hikes. And the third driver was big tech earnings reports as well next week. So I wanted to take a look at the technical analysis and see what's actually happening underneath the surface of the market to understand better what we can expect going forwards. So last week we discussed that each month there's a pattern uh, of higher lows, which reflects that investors are becoming more cautious or more fearful throughout the month, and that's followed by a spike peak, which usually happens in the last week of the month or the first weeks of the subsequent month. So we can see that's happened in November and into December with the Omicron virus. And throughout January, we had our series of higher lows, and that was followed by the spike peak here last week. We're up into that 28 to 30 range, and if we kind of look at the previous spike peak for comparison, that as well got up to 30, 32. So it is possible, just depending on the headlines that come out on those issues, that the market does actually get more volatile and have another continue its move either downwards or it makes a rebound and recovers upwards. As well, we want to have a look at our momentum on that. So back in December, we can see we had a really big spike there, and we crossed that zero line last week. So we do have more room to the upside there. The flip side of that is this could just be just as easily turned down there. So we want to be kind of cautious in this market at the moment and recognize whether or not it's time to uh, reduce our risk or if it's time to actually look at the market as having buying opportunities. So I want to look at how we can, what we can expect to happen in the market once this volatility is up in that kind of 20 to 30% range. And there's a chart that we can look at. It's this one here. And when we look at the 28 to 30% volatility index number, what that corresponds into is an expected daily volatility in the S&P 500 of between 1.8 and 1.9%. And that means that over the next few days, we can expect that market to move up or down somewhere around 1.75% to 2%. The next thing that we want to take a look at is the NASDAQ McClellan oscillator, which we use to tell whether or not the market is overbought or oversold. So what we've looked at generally is that over a period of time, the market sells off, and then there's once again a pattern of higher lows. And what that reflects is that investors are buying a little bit sooner, or being less, a little bit buying a little bit sooner when markets are not becoming as oversold, which reflects confidence by investors. And what happens is eventually there is a breakdown below that pattern, and there's some kind of a big sell-off, as we can see November and December, and that corresponded again with our volatility index. Then the market resets itself, and once again, the pattern continues upwards. Confidence returns to investors. They start to buy on each subsequent pullback until once again there's some kind of a catalyst. And this week we had the catalyst drivers, which we talked about here, and there was a market breakdown below, and we've gotten into the an oversold condition again here and down towards the minus 80 range. And what we like to do at Stock Market HQ is we like to look at this and use this as our buy zones and our sell zones. We try to take a very disciplined approach to that. We do a little bit of selling or trimming once the market gets to an overbought condition, and we start to start nibbling or adding back some of those positions once the market gets into the buy zone. So that's where we're sitting right now. And as we can also see, this when we look at the momentum here, it's not quite as low now as it was back in December, but the actual level on the overbought or at the oversold level is almost the same. So it is possible that it could be a little bit more downside, just depending on the headlines associated with some of those three main market drivers that we were talking about earlier on. Next, we want to take a look at the actual S&P 500 index. And there's a number of patterns here which we want to look at, which are going to give us some reflection on what's happening in the market. So the first one we want to take a look at always is the money flow index. So last week we talked about how for the last kind of 6 weeks, institutions hadn't really been, or there was no money flowing into, no new money flowing into the market, and there wasn't really any money flowing out of the market as either. So this week we actually had a breakdown below that pattern down to a level of 27. So just as a reminder, once the market gets down to 20, that's considered to be oversold, and when it moves up to 80 or higher, as it was back in November, that's considered to be overbought. Generally, the market will bounce off of that oversold level of 20, just kind of like we saw back in October here. However, it is possible that the market does move lower after touching that initial oversold condition. So you're just going to want to keep an eye on that. But at this point, we look like we're getting towards an oversold condition in the broader markets there. Next thing we want to take a look at is the on-balance volume. And the on-balance volume tells us whether or not institutions are accumulating shares or whether they're distributing or selling shares. So you can see we've been in a very clear downtrend here for the last kind of 6 weeks, even though the stock market has stayed at a relatively high level. And what that tells us is that institutions are still selling, that's reflected in the market price. But what is interesting here is that when we look at this level, back in September, this was the level of institutional ownership that we had. And again, we've breached that same level. What's kind of interesting is that the stock market back in September, the index level, was actually at a higher level than what we've currently got now. So that tells us that there could be a point in the near future where institutions look at the market and they consider that it is oversold, and they start to reaccumulate shares as they view stocks as going on sale and a buying opportunity. The next thing we want to take a look at is the MACD momentum indicator. So this week, the MACD momentum indicator crossed that zero line to quite a low level here. And again, if we look at that compared to previous low levels, we're getting down in that range where we could expect the market to turn upwards here. The next thing we want to take a look at is the actual index itself. So last week we took a look at the stock market, and we reflected that there was a pattern, a wedge pattern that was developing. Just like that, and we were expecting either the market to move up and break upwards out of that wedge pattern, or we were expecting the market to move downwards and break down that pattern, but there had to be some kind of a catalyst that would cause either that breakout or the breakdown for the market. As it turned out, we had those three drivers of the market, which caused the actual breakdown in the market. What we were expecting was we were expecting something in a support level of around 4,500. And as we can see, we actually broke that level. Now, it is quite common when there is a technical support level like that, it is quite common for the market to overshoot to the downside or overshoot to the upside as well when there's a big breakout. So at this point, we're kind of looking at this as a pattern that is recognizable. Now, the final thing we want to take a look at is those market drivers here. And as I mentioned, we've got those three key items that we're looking at. One of our concerns is whether or not this here is going to be the start of an actual stock market crash, if it's a bear raid, or if it is a buying opportunity. So as we look at this pattern here, we want to first of all understand the strategy of short selling hedge funds. And what short selling hedge funds do is they will borrow a whole bunch of stock from other institutions. They will sell it, dump it on the market at a high price, and their strategy is to then buy it back at a lower price. So we can see this is what they're able to do is they can manipulate the market when there's no underlying bid in the market and there are concerns or negative headlines in the market as well. And they do use high frequency trading, computer algorithms which trade or trigger off of those headlines. And we can see what happens here is that each day those short sellers are able to dump shares on the market, drive the prices down. As those prices are driven down, that causes investors' stop losses to trigger, which then creates more selling supply. And then as prices decrease further, then big money managers start to protect their losses, which creates more supply. And it becomes kind of a self-fulfilling prophecy where each day the short sellers are able to continue driving down the market. And this is exactly the pattern that happens. And as it turns out, this was the worst week since March of 2020, and March 2020 saw an almost very similar pattern here. So you want to be a little bit aware and just recognize that a lot of the stuff in the market here is expected, and it's following the strategies of short sellers at the moment. And what we can expect in the week ahead is those headlines again to continue. Whether or not the market finds a bottom here, or whether or not it has 2 or 3 more days of downside, is yet to be determined. But generally, each month we look at a drawdown somewhere around 5 to 9 business days. So we would call this somewhere around day 6. The next movement in the market is totally going to be determined by largely by the big tech earnings reports. So we do hope that helps you with your decision making, and we'll have an update for you next week. Thank you very much.